put a nickel in a slot machine in Vegas for 35 years. Well, let me ask you a question. If you walked into some casino and they said, Patrick, welcome. We're going to give you some chips here, and here's the deal. We have a special little guest table over here. We want you to have fun. So every day, as you play, you can keep up to 100% of all the money you make, up to a cap of 15% per day. Okay. But we do guarantee this, that if you lose, that you will walk out of this casino every day with what you walked in with. I'm not a gambler. I'd probably play in that one.
I would show up every day. Yeah, well, that's not gambling.
It's not gambling.
Yeah.
See, that's what I do for my clients. That's called indexing. Indexing is not a product. It's a strategy.
And just to be clear, so there's such a thing as an upside with no downside.
Yeah. Well, the downside is you might not earn anything, but you won't lose.
But that's not, as I was saying, it
and so the
limits
upside is capped, but the downside means there's a floor.
But a cap at 25% is, is like no cap at all.
Yeah. And not all of them. I have a diversified portfolio. Some have caps of 12, some 16, some 25. And that's where I have earned many, many years up to the cap. Other years I haven't, but the average has been 10.07. The cost of the insurance that the IRS says has to be there, or it won't be tax-free under the code, usually uses about 1%. But actually, this is strange. The older you get, the cheaper it becomes.
That seems counterintuitive.
Yep. Yep. Do you want me to explain why?
It's because you're paying it along the way?
Yeah, because when E.F. Hutton came up with this idea, they realized that the multi-trillion-dollar insurance industry is not only the backbone of America, but the world, okay? In fact, one of the companies where I put my money, I'm very picky. There's over 2,000 legal reserve insurance companies in the United States. Legal reserve, these are the ones that through the Great Depression came through with flying colors when 40% of banks never opened their doors again. Some real estate dropped 80%. These insurance companies back in the Depression maybe continue to pay 2 or 3%. But, 2008, people don't know how serious of shape we were in this country. And so when the mortgage meltdown happened and all this, the federal government asked the 5 major banks in America to disclose where they had their Tier 1 assets for liquidity and safety. Guess where they had 30 to 40% of their Tier 1 assets? This is money you have to have liquid on hand, safe in the event of a run on the bank. BOLI, BOLI, bank-owned life insurance contracts. What? On who? Doesn't matter. They own insurance on their president, their board of directors, their stockholders. It's the owner of the insurance contract that gets all the tax-free accumulation and tax-free access. Now, if there's insurance, you want to put it on somebody close to you. So, my clients would put it on themselves or their spouse or their children. I have several of these. My wife does. I own them on my children. My children own them on me, which will knock the socks off of any IRA or 401k. Okay? I tell my kids or my wife, try to look down and look sad at my funeral, because you're going to be loaded. That's more of that. No, it's not about the death benefit, even though the death benefit is tax-free. It's because of the inside accumulation. So simply, Hutton said, instead of trying to get this much insurance, let's say, for the least amount of premium that pays off when you die, let's use this also, or even more so, as a living benefit. Let's take the least amount of insurance the IRS will let you get away with and put in the most money, and it turns into a cash cow.
And so basically you're overfunding the insurance policy.
You're way overfunding. People say, why would you do that? Because the insurance company then receives your money, and it's way more money than they need for your chance of dying. That's called the mortality cost.
Right.
And so you have all this cash in their general account portfolio. And it's just sitting there. And so what happens is when the insurance company goes out and puts your money to work, they are earning rates of return on AAA and AA bonds and mortgages on shopping malls and skyscrapers where they only loan about 50 or 60% loan to value. This is why there's never been a legal reserve insurance company ever not honor a legitimate claim, because not only do they have a lot of liquidity and safety, but they cross-insure each other. It's way better than FDIC, in my opinion.
Wow.
Okay? So that's why they weathered the Great Depression in 2008. So what you're doing, Hutton said, let's bypass the middleman. You put your money in there. Now, when this first came out, I had 3,000 clients in mutual funds. This was 1980. My clients were never happier because I got them out, and back then, for over 10 years, in their insurance contract, they were earning between 11.75% and 15.5%. Let's just use 11. So let's go back to red light, green light. They were walking 11 steps and only 1 step back. That wasn't tax. That was the cost of the insurance that the IRS said had to be there, or it would move from Section 72E and 7702 of the Internal Revenue Code, tax-free insurance, over to the investment part of the code that is taxable. To stay under the definition of tax-free insurance, you have to have a commensurate amount of insurance coming along for the ride. So if I had $500,000, and I had many clients back in 1980, they would drop in $500,000. They were earning 11, netting 10. So if they were retired, they could pull out 50 grand a year, tax-free. Pretty nice. And they've been doing it ever since. So they're earning 11 but netting 10. That 1% was paying for the insurance, but if they died, the 500,000 blossomed to $1.2 million. You know what's interesting, Patrick? We don't object to insurance benefits. I've never had a widower turn down an insurance. Oh, no, I don't want the check. No, we object to paying for it. So from what I've just said, if you're earning 11 and netting 10, and that 1% is paying for insurance that will take your $500,000 and blossom it to $1.25 million in this example, that wasn't a cost, that was a benefit. In other words, people say, Doug, how can you afford all that life insurance? I go, well, because I'm technically not paying for it. Uncle Sam's paying for it. What do you mean? Well, it's being paid for with otherwise payable income tax. To net 10% after tax, I would have to earn 15 or 16% in my tax bracket in a mutual fund portfolio to net 10. Earn 15, net 10, because a third of it belongs to Uncle Sam. I can more conservatively, more predictably earn 11 and net 10 in the insurance contract because they don't mess around with my money in the stock market.
And I'm saying you're not at risk like you would be.
I'm not at risk.
Any others. Yeah.
Because what's happening, I mentioned indexing. So every year I have the choice. If I leave my money in the insurance company that I've overfunded, and most insurance companies have had a general account portfolio yield the last few years of about 5%. It's because of the lower rates on mortgages and what have you. Now, I can just choose anytime I want, just pay me the 5%. And that's fine. So on $1 million, they would credit me 50 grand. That's what I would do if I felt bearish about America this year. But if I feel bullish, I go, okay, I think the economy is going to grow more than 5%. So you can opt to link some or all of, let's say I have $1 million in there. I can link some or all of that million to an index or indices of my choice. The 6 companies where I put my money, and by the way, one of them manages $2.5 trillion. You know how much money that is?
A lot of money.
That's as much as the IRS collects in income taxes in a single year.
Right.
One insurance company, okay?
Wow.
They're pretty big.
Yeah.
Now, that money that I link over there, then they offer different indexes. Let's say the S&P 500 or the Dow Jones or the Russell 2000, or they have an exclusive on what is called the BUDB, the Barclays U.S. Dynamic Balance Index. So what they do is they say, oh, so you're relinquishing the for sure 5%. Yep. You can do whatever you want with that 50 grand that you're earning on my million this year. But don't put my million principal at risk. That must stay safe in your insurance company. Okay, what do they do with the 50,000? They buy upside options in the S&P or the Dow Jones or whatever. It's very simple. They're the number one purchaser of options in the world, which means this. If the S&P was up 10%, then it's very easy for them to pay me 10% instead of 5%, 100 grand instead of 50 grand, because the options matured.
Right.
If it goes up 15, it's very easy for that 50,000 to triple to 150. But they have to cap it based upon the price of options at maybe 15 or 16 or 20 or 25%. The trade-off is, if the economy tanks like 2008, and everybody else in America that had their money in the market, their million would have dropped to 600,000. I didn't lose a dime because I relinquished the 50. The options expired worthless.
Right. I was going to say, you just don't exercise the option. You're at zero.
Yeah, I end up with my million, but I didn't lose. See, sometimes zero is hero.
Right.
When you do that, and if you study the market, I know that most of the time, 70% of the time, the market's going to be up, okay? And only 30% of the time, the market's going to be down, and I will always earn 2 to 4% more than the general account portfolio rate that the insurance company's earning.